Hi, I'm Nathan Moeder with London Moeder Advisors, and this is a market update for August 5th, Monday. I woke up this morning to a couple text messages saying, "Are you looking at the stock market?" It was 6:30 in the morning, and I didn't know what was going on. But here we are at the end of Monday now. The Dow has closed down over 1,000 points, and I gotta say, I'm kind of excited about that. I feel like something is actually happening. I don't see it as a total negative thing, and here's why. What happened in the stock market today was really led by, I think, two factors. One, borrowing in yen, something called carry trades. Institutions will borrow money in foreign currencies, such as the Japanese yen, and then they'll buy securities in other countries, Mexico, Turkey, Britain, and of course, the US stock market. What happened last week is the Bank of Japan decided to increase the interest rates, which made the yen more expensive. And in order to afford that higher interest rate, the institutions had to go and sell their assets. And a lot of this is computerized, it's automated. So these are automated trades that just triggered losses or covers that they needed in order to afford the higher financing costs, mainly out of Japan. The other thing going on in the stock market is a lot of investors are just taking their gains. We've had a lot of bid up in AI technology, and that's been a little overheated. I think the jury's out right now on if we're looking at another dot-com bust, which back in that day, there was a lot of promise for these internet companies and these high-tech companies, but there really wasn't the cash flow yet. I think the same thing is going on in the AI market, not to that level, but it's an exciting technology. But in order to monetize it and how it will be used, that's kind of a wait and see how it plays out in the marketplace. For now, I think some investors are taking some of their taking their profits out of the market at this point in time. The other thing going on that has happened in the last couple of weeks is we had a weaker than expected jobs report, which if you follow the news, you've read about that. The Fed also said that they may be leaning more towards a cut in the interest rate come September. We have another jobs report between now and September that'll come out. If we see even more weaker job numbers come out, then it's most likely we're going to definitely see a decrease in the federal discount rate. Now, at the end of the day, I don't look at Fed discount rate. I don't think it matters that much other than a signal as to what's happening in the economy. The real estate perspective, I look at treasury bills, and because that's what dictates interest rates, and it also affects cap rates as a measure as well. So treasury bills were decreasing even before the Fed had their meeting, even before the jobs reports came out. It hit about 4.2% a month ago. Since then, it was down to 3.78% today. It even fell down to 3.6% today. So that's almost about 40 basis points, call it almost 50 basis points in just 1 month. We're starting to finally see some movement in treasuries. And this could play out over the future here as we close out the year and enter the fall and the winter, is we're starting to see the treasuries finally come down. When the rest of the world freaks out about stuff, whether it's the yen, indices are down, equities are down, they have this ball of money, they're sitting on cash. The safe place to go is treasuries. That's happened time and time again. We're starting to see that movement of money into treasuries, especially with a lot of the uncertainty surrounding the US economy as well. We thought we were going to have a soft landing. We may still have a soft landing. But if you're reading the articles, there's more and more talk about maybe the Fed overshot it and maybe it could be a hard landing. I don't have at this point in time one way or another if it's going to be a hard landing, soft landing, but the sentiment is there. And a lot of times recessions and other narratives are self-fulfilling prophecies that just we make them happen because we talk about it all the time. So with all that uncertainty, I see negative pressure onto the treasury bills. I would be expecting that we see treasury bills at 3.5% to 3.7% come this fall, which is a boon for real estate. When rates are lower, we're starting to see more refinancing, see more developments pencil, and the activity picks up. from my perspective, I feel like real estate has already been in a recession this past year. The industry has been stalled. We haven't had a lot of deals happening. Not a lot of capital is moving out or in. We're waiting for rates to come down so you can refinance. It's just been on this hold period. So as rates come down, even if the rest of the economy goes into recession and we lose tech jobs or business professional jobs, the real estate sector usually is the first one in. And we're also the first one out, because as rates drop to generate demand in the economy, that's when activity starts for real estate as well. So I actually took today's market news as a positive. And looking at how treasuries were falling today, that was an even more positive. So this gets me really excited that something is actually happening. It's beginning to shift. And I would expect activity to be picking up in the later half of this year. In the coming weeks, we'll be posting some videos on interpreting data, how to look at treasury bills and other indexes, and what it means for interest rates. What's going on with the spread between treasury bills and interest rates? I think there's some compression there, and we'll talk about that in a future video. We'll also be talking about the outlook for cap rates. If T-bills are on the decline and if they will stay under that 4% range, what does that mean for cap rates in the future? And what can we expect? Is that going to help values, help properties refinance? And we'll give some data and some perspective on how to interpret different indexes and also how it compares to cap rates. So that's my video for today. Stay tuned for more information. Thank you.